Well, welcome to our May 1st Friday. I can't believe how time is flying by already. It's already May. My son is pretty excited because his birthday is tomorrow, and so he's very much anticipating this month for a while. Anyways, we get into this topic today. I just had realized that there's been a lot of confusion just over and a lot of searches, people looking for what really is a financial advisor, what do they do? Are they important? All of those different things. And so what I want to do is kind of cover it in a couple categories today. First, I'm going to talk about the different kind of licenses or broad terms that people could, boil down to. I'm a financial advisor. What are those different licenses what that means? Then we're going to look at different types of advisors and what standards they have to abide by. Are they fiduciaries or they have to go to suitability standards? Who controls the licenses, and how do they get paid, which I think is a big question and often drives, whether someone works with them or not, understanding how they get paid. And it can drive what type of products are being recommended. And then we are going to talk about, how to find or how, the right advisor. So while I'm a financial advisor, of course, we're not the right fit for everyone. And we're going to talk about kind of questions to ask and really help understand the advisor that you're working with or who you may need to. Of course, we'll answer those questions for ourselves too. But that I want you to arm you with tools so you can know and how to have good conversations when you're looking for people to work with. So let's start kind of on the broad topic on who is a financial advisor. Well, that term can be used pretty broadly to encompass a lot of different financial professionals. For example, stockbrokers or registered reps they have licenses in the securities department. Then you have CFPs, who are certified financial planner, or IARs, which are investment advisor representatives. They too have licenses under FINRA or the SEC, but have went through a little bit more depth in the training that they have to go to get that. So those two designations are often the fiduciaries, okay? And we'll talk more about that as we go because they have to adhere to fiduciary standards. But also, even insurance agents could be considered a financial advisor, especially when we've talked about and broke down the colors of money, which I will attach after this too with our recording. But, green money is often sold through insurance companies. And insurance companies, to work with them, you have to have an insurance license. So those are kind of the broad concepts of who is and what is a financial advisor. I think it's important to understand that that term financial advisor could be used for any one of those things or any one of those classifications. So it's important to understand that and then how each one of them works differently. For example, a registered rep, someone who has, one of the series, maybe a 6 or 7 different, and they maybe work at a brokerage company. Edward Jones or Merrill Lynch or any of those companies that you might work with an advisor on. Some of them in there have a CFP designation, but most of the time they just have their series license, and they would be technically called a registered representative. In that term, they have to do what is suitable for a client, not what is in the fiduciary standard. So fiduciary standard means you have to do what is best for the client above any of your own preferences. Now, we all think everybody should adhere to that suitable or the fiduciary standard. And in fact, a few years ago, they tried to push it that everybody should adhere to that standard, in which I agree, everyone should. However, if you are working for a company, it might be harder to kind of make that a reality. Let me kind of expound on this. And this is whether it's a registered rep or if we flip it to the other side in insurance companies. Insurance companies have advisors. Sometimes they have agents that are captive, meaning they can only work with that company. And others can work for multiple companies and represent multiple companies. So whether you have a registered rep who is at a big brokerage house or a captive insurance agent, the first person that they are working for, or I guess who they have to account to, is the company they work for, right? Whether it's the insurance company or the brokerage company, that's who they work for. Therefore, while they need to do what is suitable and in your best interest, they also have to do what the company says, right? I've said this before, but I think it makes sense. If I am the CEO of Edward Jones, I'm going to be selling you and showing you things that Edward Jones does. If I start pointing you away to something that is not at Edward Jones, more than likely you are not going to, I'm not going to stay the CEO of Edward Jones very long. Same with an insurance company, right? If I am the head of, let's just say Allianz is an insurance company, and I start sending people to another company for product that they have that we don't, I'm not going to stay there very long. So they have to adhere to suitability standards, doing what is most suitable for their clients. But a fiduciary standard is a little bit of a step above, and it's looking for what is really in the best interest of that client. So those standards are really held by CFPs, which are certified financial planners, and IARs, or the other term would be an RIA, registered investment advisor. So the kind of the opposite of the brokerage house would be an RIA, which is a registered investment advisor. They can still offer mutual funds, ETFs, stocks, different things like that, but they do it through a different, instead of the brokerage house, they do it through their custodians, using the custodians, and they have to adhere to the suitability standards. That in large gives them the ability that they're usually working with more than one fund company, provider, whatever. They're not stuck and they're not getting compensated by that, which kind of brings me a little bit to the next point on how financial advisors kind of are paid, which goes to whether you work with a fee only, a fee-based, or a commission-based advisor. I know a lot of these topics, they really tend to intertwine, right? Like we talk about what is advisor. So I gave you all those broad terms. And then we kind of talk about, okay, so that's one area of what is an advisor, is what is their license, okay? The next way, when we could say what is an advisor, you could really break it down to, are they fee-based, are they fee only, or are they commission, okay? Now, when I do that, I think it's important to think about what that really means. So sometimes someone will say, I've heard I should work with a fee only advisor. Well, how does that person work? It can be kind of confusing to what that look like. So a fee only could be just a flat fee for a plan. You pay for the plan and you go implement it. There is some like that. Oftentimes, though, it just means you might still pay for a plan, but if they help you implement it, they're getting paid a fee, whether for assets under management based on however much you have invested, they get paid a fee for that. It can be structured in different ways, but it's just that they are getting a fee. Now, I want to flip, and that's really red money, is fees. For us, how we work, anything that we're going to do in red money, we get a fee. It's a fee only. We don't get any commissions on the red side. It's just a fee. We have a flat fee for our portfolio management. That goes with us and our portfolio advisors. So I think it's always good to just share examples as we go. Commission, I'm going to stop and kind of maybe do a little bit of a break here, because commission often refers to green money. So anything in the insurance world, whether it's life insurance, and life insurance can be used in multiple different ways and different purposes. Anybody who sells a life insurance or you put into a life insurance policy, the advisor then is paid a commission from the insurance company. Same as if you do any annuities. Whether it's a fixed or fixed indexed, they get paid a commission from the insurance company. Now, I'm going to stop real quick and just clarify. Again, I said fixed indexed, or immediate annuities are just paid a commission from the company. Usually it's a one-time, but a lot of times they'll allow the advisor to spread it over and take it over a period. It just is they're taking less each year. The one that's kind of a little bit tricky, because it gets in the middle, is a variable annuity. And a variable annuity, you're going to pay a fee for the product, but they also pay a commission to the advisor. So this is where the tricky part gets. So if we are only solely a truly green money thing, whether it's a fixed annuity or indexed annuity or life insurance, your advisor's paid completely on a commission. It comes from the company's money, okay, not directly from yours, which means if you invest $100,000 in an annuity, they are going to do all the work behind the scenes, kind of like a bank does when you put money with them, and they're going to pay the advisor from their profits, okay? Not taking it directly out of your account, okay? That's the commission based. But when you get, and green money is a commission based, you can't do a fee. It's only commission based. Red money, again, can get kind of tricky because there is times, especially I share with a variable annuity, where the advisor can get a fee for managing the annuity and get a commission for selling that. There's also things, and sometimes in the mutual fund world, where advisors or companies will get sort of kickbacks by recommending a certain fund company. For example, we'll pick on American funds just because they're big and everybody has probably heard of them. But there's some companies or advisors too that will get kickbacks from them by using their products. And that's the difference between a fee only advisor and red and a fee base where they could get commissions too. Hope that makes sense. So again, green money, it's only commissions. That's how it's paid. That's how companies work. There's not an option to do a fee if you're doing green money. And red money, I do believe it's important to work with someone that is only getting a fee, a set flat fee that they can show you. Okay. What is the fee that you're charging and what are you getting what services are you getting for that fee? Because it is a little confusing sometimes in the red world, where sometimes the fees are transparent and sometimes they are not. They're kind of hidden in the investments or hidden behind the scenes and the different fund fees that are associated with the mutual fund. So having a clear understanding of that is good. But I say that all the way to come back to when someone says I should work with a fee only advisor. It's important to, again, understand where that person is coming from and the people you're working with, how do they really work? So if I was just going to do a fee for a plan, that means I'm kind of like, think about it like I'm paying an architect to come up with a plan, and then I have to take it and go hire all the general contractors to build the house. Okay. If you're paying for a fee just for the plan, that's what it is. You're getting the plan, then you have to figure out how to implement it. Okay. If you have a fee only advisor, whether they charge you for a plan or not, if they're just charging you a set fee and they're not getting any commissions or kickbacks from anything else that they sell in red, then that would be a fee only advisor. Okay. It's a question to ask, and it should be able to be something that can be clearly explained. Okay. What is best and how do you do it? It really, to me, boils down to each person and what you're looking for. Okay. Which kind of comes to the next part a little bit. I'm just talking about when and how do you need a financial advisor? Are they all the same? So I like to break this down in a couple different stages of kind of your life. When you are accumulating and growing assets, there is a different mindset and investment strategy, so to speak, to do that than when you eventually retire and are starting to draw income from that. So, for example, sometimes 401ks will have an advisor or a representative that you can talk to, and their focus is going to be helping you accumulate, maxing out your accumulations, getting the best growth you can so you're ready to retire. That same person usually isn't as experienced as, okay, now great. Now I'm 60 years old or I'm 65 and I'm going to retire. What kind of income can I get from this? A lot of times you'll see these 401ks have these interesting planning tools that you can push numbers into their website, and they'll say, based on if you get this amount of return, this is how much income you can get. And those are all great for an example, and something to go by a little bit. However, I always say planning in life doesn't work on a spreadsheet. So when it comes to retiring and actually taking that money, it's a little bit of a different ballgame. Your strategy in your mind shifts switches a little bit. And that should be of your advisor too. So depending on when you need an advisor and if you should be working an advisor, the question should be kind of where you're at, right? And what type of advisor you should be working with. And this doesn't go back to just the designation in the title, but what is their experience and what is their focus? Okay. If you, for example, let's just put it this way. If you were a business owner and you are growing your business and that's your main goal, is growing your business and doing that, that's probably going to be a different set of professionals, tax professionals, financial professionals, than someone who is working for someone else, growing just their own personal and wanting to retire. It's different skill sets, right? Between a business and an individual. And that kind of breaks through with advisors. It's different skill sets at different periods of time in your life that you might need. So, depending on where you are, those kind of will depend on the questions you might want to ask an advisor. Now, in the Colors of Money, we have this report. I'll make sure it's linked. We talk about it a lot. It's in our book too. But it's, I think, really important to understand, again, the term financial advisor is a broad, and that break it down to who could be a financial advisor in the red, money and green money, and how they're paid and how things are done. Again, we already said there's two different, anything in red, the license is either with a FINRA or SEC, versus green is with an insurance company. Now, if I am doing something, this is where I think you got to be careful. I'm saying I only want to work with the fee only advisor, just understanding if you only want red money or if you want any green. Okay. For example, I myself cannot say I'm just a fee only advisor, because when I do green money, I get paid a commission. Now I can say whenever we do red money, we work only fee only, which means we don't get any kickbacks from using a certain company. Honestly, we don't use mutual funds, which I think we just did a video on that, why we put our portfolios together with individual stocks. That's another thing you can look at later. But the point is, we don't get kickbacks from any funds, any companies. We don't do anything that gives us a commission. If we are doing something in red, it is a flat fee. We always say it's 1.3% in most cases, and that covers us and our portfolio management team. Okay. It covers all the monitoring of your investments, the choosing of them, the trading of them, all of those things. It is a flat fee. So therefore it is fee only. But again, I can't really go out and say I'm only a fee only advisor, because we do green money and green money pays me a commission. And I don't feel like I could do the best fiduciary job for our clients if I didn't do both. Okay. The reason being that there is sometimes that people come and they really want at least some of their money secure, that's not at risk in the market at all. They don't want to take the risk. They want to secure some of it, whether it's in a fixed rate or the fixed index. Maybe they want guaranteed income, which you can generate guaranteed income through some of the annuities. There is times where people that's the things that they want. So if I did a fee only advisor, I couldn't provide some of those valuable tools and resources that our clients want. So hope that makes sense. That's the difference on why we can't say we're fee only, because we do insurance products as well. I can say in the red money I'm fee only, but it's something that you want to think about. If you were thinking about working with somebody who just charges a fee for a plan, that's it, and they don't help you implement it, then you have to go back to thinking of it like a house. Can you truly implement everything that they would recommend? And or do you want to? Okay. And then with any plan, with any financial plan, unlike building a house, it's going to take a lot up front, right, to get the general contractors and get everything in place. Once you have the house built, yes, there's some ongoing maintenance, but nothing major, right? Not big changes. You don't have to change the whole structure at any point in time. When you develop a financial plan, even if you have everything laid out and all these things initially, we have to be able to be agile to change with what's going on. And if we look at the last couple of years, there's been a lot of market volatility. There's been a lot of changes that have needed to come. I mean, you've had high interest rates, high inflation. That has also led to higher opportunities in some ways. We've had a couple of years where, the stocks and the bonds were both being hit hard. Therefore, your normal 60-40, quote unquote, conservative portfolio wasn't protecting your account. Okay. We've had times where growth companies have been in, and then times where if you were in growth companies, you were seeing big losses. There's a lot that's been changing, and your plan has to be able to be agile to be adjusted. So if you only pay someone a fee to create the plan initially, who's going to monitor all those changes? Just something to keep in mind and something to think about. So when it comes down real implications, how do you find an advisor? How do you know who you're going to work with? What is the best way? I think there's really comes down to some important questions. Okay. Now, lots of times you might be used to, and of course, if you've talked with us, there's questions we ask initially, kind of things like, "What do you want? What are you looking for?" A lot of times, our focus is really those that are in or near retirement. So one of our main questions is going to be, "What do you want retirement to look like? What do you want to do? What type of income do you want?" Those are questions that we as advisors ask. But you as an individual also need to kind of have questions, so to speak, meaning it can be flipped. What is your specialty? Who are the people you work with for the most part? If you are nearing retirement and you're trying to set something up, an income plan, and you're talking to an advisor, and most of what they do is help people get started in their 401ks, there's probably an offset, right? It's not the same experience that you want. So it's important to ask the person you're working with, what is their focus? Without, asking a bunch of preconceived ideas, just say, what's your focus? Who do you normally work with? And listen to their answer. The next question would be, what is your process? Okay. Now, to me, this question can take on a lot of different forms. So it's really important to think about these things in a couple steps. So, example, what is your process when working with someone? That's the first process, right? Um, and I'm going to give you our examples as I talk through this because I think it helps to get some answers. But we've outlined our process, in our Creating Your Dream Retirement in our book, which is, what do you want? What do you have? What do you need? And what to do? And we talk about that, right? What do you want? What do you want things to look like? That is a lot of our first conversation. What do you have is way more than just, a spreadsheet with numbers on it or statements. Is what kind of risk do you really have? What are some obstacles that are there? What are some opportunities that are available? Okay. And then what do you need to in order to accomplish what you want, in order to get the income you want or whatever else it is that's on your want list? What are the things you need to do or adjust, if anything, to get that to happen? And then of course that comes down with what to do. Now, that's an overall process for us. That's one thing. But inside our process, there's processes. I know that might sound crazy, but it's true. So when it comes to, let's say we went through all this and we're going to put some of the money in green for the guaranteed portion, and we have some invested in red. Well, then there's another question. What's your investment process? Okay. How are you picking the funds you're in? Do you ever change it? How do you change it? When you change it? Those are things that are important too. If an advisor says, here's your risk tolerance, and I have you take this, and then we create this colorful pie chart, and then we leave it because, you're investing for the long haul and over time it or do well. Okay. Well, it's understand that process. So if they're going to set it once and it's kind of set it and forget it, are you comfortable with that? Or how are they monitoring it all the time? Are they looking at it as a computer algorithm and changing only when the computer says? Is it self-balanced? Like, really, those are questions that should be asked. And you don't have to know the huge details. I'm not out telling you need to be a get your PhD in finance to understand these, but you should be able to understand the process they're giving you. What is their process for picking the investments? What's their process for managing it? Okay. Then what's really important too is if you're taking income, okay, again, if you're in retirement taking income, what's the process and the plan to protect for your retirement income? Is it just kind of a set number that fits, that is going to, over time should work? I know a lot of times advisors will run these big reports, and a lot of times they're called Monte Carlo reports, where they run thousands of market scenarios and says, well, based on this, 90% of the time your income should be okay. So really then they're setting a percentage and taking it. Again, that goes to how they're investing. It's important to understand the process. That's a question that you can ask, and you should be able to get an answer that you can understand. That is one thing I will say that should be a complete red flag is this. If you ask a question and you can't get it in an answer in straight English that you can understand, if it's full with financial jargon and you just are like more confused than you started, that should be probably a red flag. Okay. If you can say, hey, I don't really understand, can you break it down? And you don't have to understand all the ins and outs, but you should be able to understand the concept. For example, if we were going to talk about with our portfolio manager, how do we manage when it's in red? We're going to break down, and usually Guy would be on too. He's our portfolio manager. Based on your risk level, we're going to put together a portfolio with stocks and maybe bonds that will meet your goals over time. And we're going to adjust it based on what's going on in the environment. So we'll give an example of what happened in maybe 2020, how an adjustment was made. That is something that everybody can relate with. We've talked about it often. Is, in that period, we didn't want to be in hospitality type industries. They were going to suffer, but we really wanted to be in maybe some healthcare, some consumer staples, companies like Amazon and Zoom, who were poised to do well. So the portfolio was transitioned to reflect that. Simple, you can probably understand without me getting into all kind of jargon on financial terms. The next thing is, how do we manage your income if you're taking it? And Guy, we've had some videos on this as well, which we'll link, but it'll be talking about, we're going to make sure that the next, at least if you're taking income, at least 2 years of your income is protected. That means it's either in cash or appreciated assets or things that are not correlated to other assets, meaning if the market's down in one area, we have something that's up over here, and that's where your income's going to come from. And by doing that, they're confident we can get 5 to 6% income a year safely. Again, without going into huge details, I think you can understand that process. So that's a question you want to ask and be able to get something that's simple that you can understand. The last question you should probably ask, that I'm going to talk about today, to ask a financial advisor is, how do they get paid? And we get asked this all the time. And I try to answer it before it's asked, but sometimes we just get into conversations and I don't think about it. Okay. But it's in the Colors of Money that we send out. It's in our book. We talk about it quite often. It depends on what we do. If we work in green money, this is how we get paid. If we work in red money, this is how we get paid. Now, how do we determine what goes in green and what goes in red? It all comes back to you and the questions you talked about what you want. Then we'll create the plan that makes the most sense of how much is in green, how much is in red to meet your goals. Most of the time, it's a combination of both. Okay. And then, as I already mentioned, I shared with you what our fees are when we do red money. It's a 1.3% flat fee that includes all of the things that we do to help you with the overall plan, help you when you're taking money out, making any changes. It includes Guy and the portfolio team who's monitoring it and making those changes based on what's happening in a like the economic perspective. They doing all of that, that's what those fees cover. So if you're working with someone, you want to know the fees, okay? And if you don't get quite a real answer, again, those are red flags. You want to break it down. And if you can say, if they say, oh, my management fee is 0.25%, okay, well, is there any other fees? Do you get kickbacks? Do you get commissions? Those are questions that you can ask to help determine if the person you're working with is who you want to work with. But I think really it comes down to clear communication and making sure that you're understanding the person you're working with and understanding in multiple ways. One, are they the advisor? Do they have the experience for the time in your life or what you're doing right now? Do they have that experience? Two, can they answer the questions about their process? Because honestly, sometimes people get bogged down with what a fee is. Someone will say, oh, well, I think 1.3 is too high. Most advisors charge 1 or whatever. Or you can go back and forth on that, but it comes down to what's the value that you're getting. And I don't care if you were paying, a 0.5%. You might be paying too much if you're not getting value for it, right? If all you're getting is a robo investing and they're just putting your money in funds and setting it and forgetting it, then you could do that on your own, right? You could go and take the same thing and do it in low cost funds. So it's not about the amount, it's what the value is, okay? Understanding what the value is for the fees that you're paying and having a clear idea of what you're actually paying for. And then again, the communication of the process, that's part of it all, right? The clear communication of what they're doing for their fees and how they're getting paid. So I know it's very broad. Hopefully that helps clear up the different types of people. Again, financial advisor can be broad. Not all financial advisors, because it can be used in a broad term, they're not all fiduciaries. You have to have those certain license to be a fiduciary, the CFP or a registered investment advisor. Under those standards, they can be fiduciaries. I think it's also, though, important to know if you're working with anyone who is captive to any company, they're going to be having to, first and foremost, they work for the company they work for, right? And they're going to have to do what that company recommends. So that's important to know. And I know some great people who work, great financial advisors working, in more of a captive way. Doesn't mean they're bad people. You just have to understand that they have to do whatever that company wants. That's their first priority. They have to do what's suitable for you, but they have to stay within the constraints of the company they're working for, whether that be a brokerage house or an insurance company. So again, that term can be used broadly, but understanding a fiduciary, what their standards are, and then, in my opinion, it really goes down to having the ability to be able to do both red and green, which comes to how the advisor's paid. Being fee only or fee based or commission, we talked about that. And if you get too stuck in any of those details, then sometimes you're missing out. So hopefully this helped clarify some things for you. We will have this post. When I post this video, I'm going to post some other links that talk about the colors of money and how advisors are paid, talk about the process that can be used, or questions that you could ask to make sure you're working with someone to understand it. And questions you're always welcome to ask us. So anyway, with that said, I think I answered most questions that I saw come in kind of throughout the talk. But you can always reach out. We're happy to answer any questions individually. We want to make sure that you have confidence, whether you're working with us or you work with somebody else, that you have confidence and that the person you're working with is the right fit. Again, we're not the right fit for everybody. We do have our area of specialties, which is really retirement planning, helping people that are to the retirement or close to retirement, helping you transition so that that money is there for you when you need it, and it can create income for your retirement. And then the next phase of that too is to be able to pass it if you're not here in the most efficient way. So again, not a fit for everybody. And we already talked about how we get paid, how things work. There's sometimes that's not a fit, and that's okay. So if it's not, hopefully these questions will help arm you the next time you're having a conversation trying to find the right person to work with. All right, we'll talk to you later. Have a great day.